Commissioner of the Financial Sector Conduct Authority here in South Africa. And really is an honor for me to welcome you to yet another conversation on AI. We've had a few between yesterday and today. But while it was good to listen to some of the more macro-oriented conversations on the impact of AI, we thought what we would do this afternoon is to have a specific and a focused conversation on AI adoption and deployment in the financial sector, build an understanding, I think, and make meaning of the extent of AI deployment that we see, and consider together some of the policy and regulatory questions that this rapid transformation that we are seeing presents for us as regulators, but as policymakers as well. We are happy to be co-hosting this roundtable with the OECD. They've done and continue to do really interesting and relevant work in this area, and really help to shape the thinking in terms of regulatory and policy responses to AI. And it's obviously a very relevant conversation for the finance track agenda as well. So to kick us off and to provide welcoming remarks, we will hear from two distinguished leaders who bring valuable global and institutional perspectives to the topic that we're going to talk about today. And first, it's my great pleasure to introduce and invite Mr. Lesetja Kganyago, the Governor of the South African Reserve Bank, to deliver the welcoming remarks. Governor, the floor is yours.
Thank you. Initially, I thought I will talk about AI and health, but I didn't get invited to that round table. It's good to thank you very much, Unathi. Good to see the Secretary-General of the OECD also here, and colleagues in central banking. Distinguished guests, representatives of ministries of finance, ladies and gentlemen. It's a great pleasure to open this timely dialogue on artificial intelligence in finance. This morning I was talking about artificial intelligence and productivity and implications for labor market. By the end of these meetings, I'm sure I could safely go onto the circuit as an AI speaker. But I want to begin not with the intricacies of neural networks or large language models, but with the bedrock of our shared purpose as guardians of the financial sector. Our mandates, while varied in their specifics, tend to converge on key fundamentals to safeguard financial stability, to uphold efficient operation of financial markets, and to deliver robust consumer protection. These are not abstract goals. They are the tangible promises that we make to our citizens. The central question is not whether AI will change finance, but how we as guardians of the system will actively shape its integration to harness its potential while mitigating its perils, all in service of our mandates. AI presents a profound duality, a landscape of immense opportunity interwoven with significant risk. We must assess this duality not with techno-optimism or dystopian fear, but through the clear, sharp prism of our mandates. For financial stability, AI pushes the frontiers of risk management. At the micro-prudential level, it can empower supervised institutions to identify and manage credit, market and operational risks with unprecedented speed and precision. Well, that makes supervision actually challenging. So in 2002, South Africa experienced a banking crisis. And the bank supervisors would convene us twice a day. And in the morning, they would round up the banks to get forms filled and then establish what the status of each bank is. And at midday, they would do that, and they would meet on their own, and in the afternoon, they would come and talk to us. This is what we are seeing in the banks. A week and a half into the crisis, somebody comes from the payment systems department, walks into the meeting and says, I'm sorry to burst, but there is so much money moving from this bank to all the other banks, which meant there was a new bank run. But the supervisors were stuck with forms when the people in the payment system could see this stuff. Which brings me to the important issue of the fact that AI depends on data also and data infrastructure. And central banks are sitting with this data and with all of these systems. It was not rocket science that actually with tools you could actually mine this data, and we could have actually picked up much earlier that there is a bank run actually taking place. And so if the sector that we supervise is deploying these tools and can assess things and manage the risk and move faster, and our supervisors are still stuck with Form FA 105 and form whatever, we have a problem. But even from a macro-prudential perspective, AI can be deployed to mine this data. So in micro, there are issues that AI would provide an opportunity for advanced supervisory technology, or SupTech as it is called, and tools to analyze from a macro perspective, vast data sets, detecting and mapping systemic risks that build up invisibly across the system before they cascade into a full-blown crisis. For fair market conduct and consumer protection, AI holds the promise of radical financial inclusion by creating new pathways for citizens and small businesses to access the formal economy and build wealth supported by AI-driven credit scoring models. However, each of these opportunities could be overshadowed by a corresponding financial stability threat, like algorithmic head behavior, which can rapidly amplify market shocks. The growing reliance on a concentration of global tech firms for critical infrastructure creates systemic risks if one fails. From an inclusiveness perspective, AI systems can perpetuate bias from historical data, undermining fair market practices and consumer protection. The complexity of black box models makes oversight difficult, threatening both financial soundness and consumer fairness. Regulators must actively engage with these challenges, both local and learning from other authorities already dealing with AIs are essential. Drawing on lessons from our peers around the world brings us to the ultimate challenge for this roundtable. How do we collectively and as individual institutions continue to successfully execute our core mandates in an age of AI? I think it is imperative that we collaborate on these initiatives. Examples of this could potentially include developing a shared global taxonomy for AI model risk management to create a common benchmark for safety and soundness, or creating cooperative oversight models and information sharing agreements for the cross-border technology providers that serve all our markets. Let me conclude by emphasizing that technology will change. The tools we use will evolve beyond recognition, but our mandates remain constant. It is a promise of stability in the value of the money of the people who are users of the financial system. Our task is to ensure that as this new technological frontier unfolds, our commitment and our ability to fulfill that multifaceted promise to preserve savings and promotion of fair access to opportunities remain unwavering. With that, my task is done because my notes say that you must now formally declare the round table open. And so I declare it open.
And thank you very much, Governor, for the welcoming remarks and just your thoughtfulness in terms of some of the issues we have to be considering and thinking about this afternoon. Thank you for that. We will now turn to our opening address, which will be delivered by the Secretary-General of the OECD, Mr. Mathias Cormann. As I've indicated earlier, OECD is our partner and co-host for this roundtable, and we are very grateful for their partnership. Secretary-General, over to you.
Thank you very much, Commissioner, Governor, colleagues. Thank you very much to the South African G20 presidency for organizing this roundtable on II and finance, and also for the opportunity to exchange on how government policies can encourage II-driven innovation in financial markets in a safe and trustworthy manner. II adoption is rapidly advancing across a number of sectors of the economy, but in particular the financial sector, redefining how institutions in banking, insurance, asset management, and securities trading operate. Advanced generative AI models are already boosting operational efficiency in back-office functions and improving customer service through AI-powered tools such as chatbots. Though having been at the other end of a chatbot, I'm not so sure how consumer-friendly some of those interactions are at this point. No doubt that will be further improved moving forward. The use of predictive AI technologies is also accelerating in areas such as risk modeling, trading, fraud detection, and financial crime prevention. The potential benefits for productivity are indeed significant. In fact, our latest estimates at the OECD, which we released last month, show that expected productivity gains from AI in the finance sector are among the highest of all sectors. In fact, we assess it at 12% of productivity growth in the sector across G7 economies over the next decade. We are now working on expanding these estimates to a broader set of countries, and as part of a report that we're preparing for the G20 presidency of South Africa. AI can also contribute to greater financial inclusion by broadening access to financial services for underserved or traditionally excluded populations. For example, AI can facilitate the assessment of the creditworthiness of borrowers who have no credit history, as is the case of many small and medium-sized enterprises. At the same time, the use of generative AI, as always, raises risks. Specifically, it raises the risks of financial fraud and scams, as well as cyber attacks, among other concerns for consumers and businesses. The OECD was supporting governments in encouraging the safe, secure, and trustworthy use of AI in finance, while safeguarding consumers and markets. First, we are promoting a better understanding of the specific risks associated with the use of AI in the financial sector, and one such risk relates to market concentration. Currently, only a handful of firms develop and supply advanced AI tools and the infrastructure required to deploy them, which creates a situation where a disruption or shock affecting a major AI provider could cascade through the entire financial system. The use of AI in financial markets can also increase market volatility if a significant number of participants rely on similar AI models, leading to a convergence of trading strategies and feedback loops between models. Promoting Competition, including through technology-neutral regulation, will be key to alleviating some of these risks. Second, we're providing data and recommendations to governments to address potential risks for consumers. And our latest consumer finance risk monitor shows that the use of AI in credit assessments and insurance underwriting can compromise consumer privacy and potentially lead to discrimination and bias in access to financial services. The G20 OECD high-level principles on financial consumer protection set out the key elements of a policy framework to address these concerns and safeguard consumers from regulatory supervision to financial education to requirements for transparency of digital finance tools. We continue to support countries in implementing these principles, and most recently, Ireland's central bank with recommendations launched in December last year. Third, we're providing a platform for governments and financial supervisors to share experiences with AI. This includes identifying challenges associated with AI for market supervision and using AI tools to assist regulators with tasks such as large-scale data analysis, market surveillance, and automated compliance verification. In September, the OECD Committee on Financial Markets will discuss supervisory approaches that balance the promotion of responsible AI in finance with policy objectives of market stability, integrity, and financial consumer protection. So in conclusion, the rapid adoption of AI in finance is driving substantial productivity gains, and it is unlocking new opportunities to expand financial inclusion by making services more accessible and more affordable to consumers. But at the same time, effective regulation is essential to manage the new risks that these innovations introduce. And at the OECD, we very much look forward to continuing working with you to monitor these risks and to ensure that regulatory and supervisory frameworks are based on evidence and promote safe, secure and trustworthy AI innovation and diffusion in finance. Thank you.
Thank you very much, Secretary General, for those insightful remarks. We will now, colleagues, proceed to the main part of our program, which is the roundtable conversation itself. I want to start by introducing the participants that we have on the roundtable, starting on my left with Mr. Kamlana, who is the OECD Director for Financial and Enterprise Affairs. He will go first and give us a scene-setting presentation on the evolution of AI use in the financial sector. After that, we will then have a conversation between the participants, sharing both their experiences and reflections on the presentation that he will have made. On my right, I have Mr. Shigeru Arizumi, who is the Vice Minister for International Affairs and the Financial Services Agency of Japan, who will also share with us the Japanese experience. And Mr. Paolo Pichetti, the Deputy Governor, Central Bank of Brazil, who will also talk to us about what they are doing in Brazil, including the recently established Center for Excellence for Data Science and AI. And Mr. Luigi Signorini, Senior Deputy Governor, Bank of Italy, who will also share with us the Italian experience. And I have, to my right, Ms. Catherine Gibson, who is the Deputy Commissioner, Financial Sector Conduct Authority, who will bring the South African perspective and the work that we are doing with our sister regulator in this space. And last but not least, Mr. Vasilios Madouros, who is Deputy Governor, Central Bank of Ireland, will also come in at the end to provide the hypnosis of the conversation, but also share from Ireland's experience as well. So thank you very much with that. Carmen, let me hand over to you.
Thank you, Unathi, and it's a pleasure to join you today at this G20 roundtable on AI in finance, which we have the pleasure to co-host with FSCA and in the framework of the G20 South African presidency. I will give you, there should be some slides very quickly, a short presentation on to set the scene for the panel discussion based on some OECD analysis and an ongoing discussion around basically, let's see if the slides will go up, but otherwise, the current basically state of play of AI use in finance, including the emergence of generative AI and some of the key risks and regulatory challenges, the regulatory landscape for AI in finance, and how OECD standards such as the OECD AI principles and the G20 OECD high-level principles of financial and consumer protection provide a foundation for responsible AI innovation in finance. Let's see if we have the slides on, but I will move on. Now, AI, it was heavily, okay, perfect. This was the outline. Okay. AI is no longer a futuristic concept. It's already widely deployed across financial markets, from banking and insurance to asset management and fintech. And so AI is transforming how financial firms operate, assess risks, and serve clients. Actually, an OECD survey last year of 49 jurisdictions showed that financial institutions now use AI for a very broad range of tasks, from fraud detection and credit scoring to customer service and portfolio optimization. And this widespread adoption is reshaping operations, producing efficiencies, and improving competitiveness of financial markets. Now, the rise of generative AI has been the inflection point of AI innovation, while the advent of larger language models such as ChatGPT has democratized its usage. Deployment in finance is still cautious and measured. The potential of such advanced AI models is immense. Generative AI can enhance productivity and support economic growth. However, in finance, it remains largely a supporting tool to assist the human decision-making rather than really to replace it. The slower path of generative AI adoption in finance reflects the sector's sensitivity to risk, given reputational challenges and the importance of trust and accountability. It's also due to the fact that the generative AI amplifies existing risks, for example, relating to data bias and discriminatory outcomes or cybersecurity threats. In addition, it also creates new risks around model opacity and lack of explainability, or with increasing dependence, as it was mentioned, a small number of concentrated third-party providers for models or services related to AI deployment, as Secretary-General Cormann highlighted. So these risks make regulatory vigilance, also as the Governor mentioned, even more critical. Now, the result of the OECD analysis of AI regulation in finance shows that most jurisdictions do not see an immediate need for new AI-specific regulation in finance. Appropriate financial regulations are already in place to cover for the use of AI in finance, and this includes pre-existing regulation, newly introduced product regulations such as the EU AI Act, and cross-sectoral rules, as well as non-binding policy guidance with a national or sectorial focus. Since financial regulations follows a technology-neutral principle, existing laws, rules, and guidance remain applicable regardless of the technology. This includes regulations on prudent business practices, consumer and investor protection, cybersecurity, and operational resilience, among other areas. Advances in technology do not render existing safety and soundness standards or compliance requirements obsolete, even more so in finance, where models have been part of the business model of financial market participants for many decades now. This pragmatic approach allows for innovation while maintaining safeguards, but it also requires that regulators stay agile and informed. So ongoing monitoring is essential, and sharing information. Our analysis highlights that while current rules may be broadly applicable, there may be potential gaps, particularly around explainability, accountability, and the use of third-party AI systems. Regulators must continue to review their frameworks to ensure they remain fit for purpose in a rapidly evolving landscape. To support this, the OECD last year revised its AI principle, first agreed in 2019. They serve as a global reference point for policymakers and other AI actors, helping to align innovation with public interest. The AI principles have been endorsed by over 40 countries and promote a trustworthy AI that is transparent, robust, fair, and accountable. And in parallel, the G20 OECD high-level principles on financial consumer protection provide a comprehensive framework to ensure the consumers are supported and protected, especially as financial services become more digital and data-driven. These principles emphasize fairness, transparency, and redress, and all core values that must guide the use of AI in financial services. So to conclude, AI offers tremendous opportunities for the financial sector, but it also demands thoughtful governance. At the OECD, we continue to study this area through our work on the financial supervision of AI in finance and on the interdependencies between AI innovation and open finance frameworks. By working together across jurisdictions, we can shape a future where responsible AI enhances financial inclusion, resilience, and trust. So I look forward to hearing from our distinguished speakers, and back to you, Chair.
Thank you very much. Very efficient presentation coming, which we appreciate. All right, we will now hear reflections from the participants from the round table, and we will start with you, Shigeru.
Thank you very much, Unathi, and thank you very much for this great opportunity on AI, which is clearly a very important issue for central banks and other supervisory authorities. So thank you very much. Let me briefly share a Japanese perspective. The Japanese government has been actively promoting the sound use of AI. As a G7 presidency in 2023, we announced the Responsible AI Principles in Hiroshima. And this May, we actually passed a new AI Act, which aims to foster AI research, development, applications in a responsible way. So in line with this direction, the FSA has been working to encourage responsible development of AI in the financial sector. First, we take what people would call a principle-based approach. We believe that we need to be flexible in responding to rapid innovations such as AI. Hard law could quickly become obsolete, and if you want to be ahead of the curve, then you could stifle innovation and you can be less competitive. So there's a fine balance to strike there on what kind of a structure you would emphasize in terms of treatment of AI. So based on this thinking, our thinking is to sort of build on existing rules and regulations, as Carmen highlighted in the OECD report, through appropriate implementation and application. Second, if we are to take this approach, we need to provide clarity and comfort for various stakeholders, including the industry. So in that regard, we should be clear as possible in our interpretation and application of law, not only to sort of ensure due process, but to communicate our thinking in a forward-looking manner. This is particularly important for financial innovation, including AI, because we need to strike a fine balance between seizing the opportunities while addressing the risks posed in the financial sector. So as a practical step, we follow the footsteps of perhaps the OECD that we got. We did a comprehensive survey late last year, similar to the one presented just by the OECD. The aim was to better understand the current use, the challenges, and the potential risks of AI across financial institutions. And based on this survey, we published the FSA's first comprehensive paper on AI, what we call the AI discussion paper, this March. And building on our paper, we launched what we call the AI Public-Private Forum, which gathers not only regulators and supervisors, but also the industry, not only financial, but also from the tech. We also reach out to academia to sort of gather what is happening on the ground. And this is very much important because we need to, the regulators and supervisors need to know what is happening on the ground, so we are not late in our thinking or calibration on regulatory or supervisory implications. But at the same time, we need to communicate what we could be concerned about to the stakeholders. And hopefully that will in turn be reflected in ways of being responsible in AI development. So we think such kind of a conversation would be extremely important moving forward. Last but not least, we should be mindful of the risks of being too cautious on AI adoption from a longer-term economic competitiveness perspective. So similar to internet and cloud computing, AI has the potential to become a core strategy, a core technology that fundamentally transforms the business models of financial institutions. So in that regard, according to our AI discussion paper, we emphasize the risk of not taking action as one of the most critical concerns moving forward. So let me stop there. Thank you.
Thank you very much, Shigeru. Paulo?
Thank you, Chair, and thank you for the opportunity for sharing the Brazilian experience. So the rise of artificial intelligence marks a profound structural trend shift that challenges traditional paradigms and compels us as central bankers to rethink how we fulfill our mandates. But the Central Bank of Brazil will recognize that the implications of AI are far-reaching and nuanced. While its promise of automation and efficiency may translate into productivity-level gains and on aggregate support strong and sustainable growth, the composition of these gains matters. Balanced and inclusive growth is not guaranteed by technological progress alone. In fact, the distributional consequences of AI can introduce new trade-offs that touch the core of our responsibilities. Indeed, while advances that support the strong and sustainable dimensions may assist with price stability, a weakening of balanced and inclusive outcomes can hinder our ability to deliver full employment. This presents an objective challenge. Our traditional instruments are ill-suited to address distributional imbalances. As such, cooperation with other policymakers becomes not just desirable, but essential. In the financial sector, AI is following the well-known pattern of fast and widespread adoption, much like previous waves of technological innovation. This intensifies the need for us to uphold our mandate to safeguard financial stability and promote the economic and financial well-being of society. It also underscores the importance of cooperation among central banks, regulatory authorities, and international organizations. So, having said that, I have 3 points to make. The first one is that we must embrace the opportunities of responsible innovation while fostering candid and ongoing dialogue around the governance and regulation of the AI in the financial system. Our engagement must match the pace and complexity of these developments, and our actions must reflect the same agility and adaptability that innovation demands. Efforts to govern AI should reflect our long-standing principles: transparency, mutual learning, and coordination. Tools that have proven effective in absorbing past innovations, such as regulatory sandboxes and public consultations, remain useful in calibrating proportionate and effective guidelines for AI. In this spirit, the Central Bank of Brazil has made innovation a cornerstone of our strategic planning. One of our core institutional objectives is to enhance our operations through the adoption of new technologies, the efficient use of resources, and the alignment of our practices with international developments. We are advancing on several fronts to ensure that AI is integrated responsibly and effectively into our framework. A key initiative is the development of a dedicated AI governance policy, expected to be finalized by the end of 2025. This policy will provide a comprehensive framework for the ethical, secure, and transparent use of AI across our institution. While this policy is under construction, we currently rely on our software product governance policy, which, though not specific to AI, offers robust guidance for managing software solutions, including those incorporating machine learning models. My second point is we must invest in our people. Their skills and motivations must evolve in tandem with the technology itself. To support this institution, we launched the Center of Excellence for Data Science and Artificial Intelligence in September 2024. This internal community of practice brings together representatives from all central bank's departments and is coordinated by our IT department. Its mission includes promoting the ethical use of AI, establishing requirements for generative tools and supporting training in close collaboration with our Human Resources Department. We are also developing a secure Gen AI platform to apply generative models to internal data, boosting our analytical capacity while ensuring rigorous data governance and security standards. We have launched an institutional project to study AI use across the financial system, and we are analyzing data from over 600 institutions. Those insights will inform future regulatory actions and help us understand current practices and emerging trends. At the same time, AI introduces serious challenges. This includes the emergence of sophisticated cyber threats enabled by generative models, increasing reliance on a narrow group of technology providers, the opacity of black box models, and the potential for biased or incomplete data to produce discriminatory outcomes, particularly in areas like credit scoring and insurance, like you mentioned. Our current regulatory framework for operational technology risk already applies to AI. At the national level, Brazil is advancing the Brazil AI Bill, which proposes a national system for AI regulation and governance. As we move forward, we believe a multifaceted approach is essential. This includes strengthening internal governance and risk management frameworks, investing in human capital and cultivating a culture of innovation, enhancing data quality and governance, adopting regulatory tools to AI-specific risks, and promoting international cooperation and knowledge sharing. My final point is this: the rise of AI is global, not a local phenomenon. As such, we place high value on international cooperation to navigate its complexities and avoid regulatory arbitrage. Artificial intelligence is reshaping the world around us, and central banks are no exception. So, as a last comment, I would strongly recommend for everybody who haven't done so already to read Yuval Harari's latest book, Nexus, which has lots of very important insights for us in what regards the adoption of this technology. And last, by the way of full disclosure, these notes were refined with the use of AI. Thank you.
Thank you very much, Paolo. All right, let's move to Luigi for your remarks.
Thank you very much. And yes, you're right. We have been talking so much about AI recently that I think that any half-decent LLM would have more than enough material to write a good intervention. But no, I asked my staff to prepare my intervention, and what is worse, I even myself dedicated some time to actually working on it to make it sound more like I wanted it. So, with all this, I won't be very original in saying that the use of artificial intelligence can bring substantial benefits in financial services, has the potential to improve the quality and efficiency of services in areas like personal financial advice, credit risk assessment, customer support, claims handling, and truly many more. Can strengthen fraud detection, improve the security of transactions, can help authorities themselves in carrying out their tasks such as prudential supervision, market surveillance, market abuse, monitoring, and sanction screening. It can assist market institutions in ensuring regulatory compliance, including in the field of money laundering. To reap those benefits in full, of course, both private agents and authorities need to take due care of the risks that AI, like all new technologies entail. And people have spoken so much about those risks in the previous intervention that I think I can skip this part and go directly to our own experience. In Italy, like everywhere else, the adoption of AI by supervised financial intermediaries has accelerated markedly in recent times. Investments by Italian intermediaries in projects incorporating AI-based techniques has more than quadrupled over the last 2 years, with Gen AI leading both in terms of total investment and number of new initiatives launched. More generally, data from our biennial fintech survey showed that investment in Italian banks in the most innovative technological projects has grown from less than 0.5% of operating costs in 2017 to 18 to almost 1.5% in the most recent couple of years. Banks and other intermediaries are benefiting from the ability of AI to process a broader and more diverse set of information and traditional models, improving, among other things, their ability to assess credit risk and their ability to have an early detection of a loan deterioration. About 3/4 of significant banks in Italy are using artificial intelligence and big data technologies in the assessment of creditworthiness, with another 10% having projects under development. Customers are benefiting too. We have evidence that AI can improve access to credit for business with shorter credit histories or more fragmented information. Furthermore, banks that make extensive use of these technologies tend to support the most dynamic businesses more actively. On the regulatory side, the OECD data show that many jurisdictions have regulation in place that the OECD itself assesses as appropriate. The EU has adopted a comparatively prescriptive regulatory approach. The European AI Act entered into force on 2 August 2026, and it has established a comprehensive, risk-based, legally binding framework which aims to ensure a high level of protection against possible harmful effect of AI and an elaborate enforcement mechanism. It is important that European and national authorities make it work smoothly and flexibly, avoiding regulatory overlaps and effectively coordinating surveillance action. We favour a pragmatic and flexible approach, one that quickly adapts to advances in technology and, thanks to effective intra-EU coordination, fully preserves the benefits of the single market. As conduct oversight authorities, the Banca d'Italia and IVAS, a sister institution entrusted with insurance supervision in Italy, need to ensure that AI works for consumers, helping create a more inclusive, transparent, and equitable financial system. AI can be instrumental in increasing digital literacy and financial inclusion. Conversational interfaces, with all their teething problems, so to speak, it can facilitate users' decisions about budgeting, saving, digital banking, and loan options. Tools based on machine learning can propose personalized solutions for saving plans, insurance, or small loans that are tailored to individual needs. Importantly, and as has already been mentioned, AI can bring down barriers that exclude underserved segments of the population from financial services. Authorities should promote financial education initiatives to stave off newer forms of financial exclusion, ensure that products are offered in a fair and appropriate way, and help empower customers to exploit the new opportunities to the full. Authorities also can benefit from the use of AI, especially by improving their data analysis toolkit. The Banca d'Italia and IVAS are working on this. Ongoing projects include structured assistance to analysts in identifying complex ownership structures, evaluating corporate governance issues, conducting fit and proper assessments, comparing on-site evidence across intermediaries, detecting improper conduct. Investment in this area in our institutions are growing. At the same time, we are determined to preserve the key role of the critical judgment and experience of human supervisors. It seems appropriate to mention here that the Banca d'Italia started a joint project with the OECD and the European Commission on AI in the Italian financial markets. 4 key areas are being considered: improving the regulatory framework, strengthening supervisory approaches, promoting innovation through catalytic measures such as innovation facilitators, and increasing the efficiency of authorities' internal processes. The OECD project combines structured dialogue with the financial industry, targeted exchanges with public authorities, and evidence-based analysis. It engages experts from both the private and public sectors in Italy and other advanced economies. And this open and cross-jurisdictional process is meant to foster cooperation and peer learning and help you identify areas where regulation could be improved or simplified. Though based on the Italian context, the approach and findings may be scalable and transferable to other jurisdictions. Ultimately, the project aims to understand how AI can improve the efficiency of financial markets and widen access to them for businesses and households, thereby strengthening the competitiveness of the financial industry and its ability to promote sustainable growth and job creation. AI is very much a subject of the day in many circles. It raises passionate debates, just as happened with other industrial revolutions in the past. Voices range in tone from the apocalyptic to the messianic. The extreme fears that some hold are very likely to be misplaced. But authorities must be alert to the concrete and sometimes insidious risks that may actually arise from various sides and ready to adapt a judgment and priorities as the new technology develops and our unavoidable ignorance about them is reduced. They should, however, we should, however, never lose sight of the large welfare improving potential that an industrial revolution like this is likely to have, and of the need to unleash human inventiveness and creative economic initiative so that they may discover it. Thank you.
Thank you very much, Luigi. And now, Kathy, let's move on to you for the Mzansi flavor.
Good afternoon. Even struggling with the most basic of technology. So today I will share some of the learnings from a comprehensive joint study similar to that's been described by both Japan and Brazil. That's been conducted by South Africa's twin peaks, being ourselves, the Financial Sector Conduct Authority, and our Prudential Authority that sits within the Reserve Bank, which is on the state of AI in South Africa's financial sector and the intersection with, between financial stability, prudential oversight, and consumer protection. So the soon-to-be-published report is the culmination of a recent survey of over about 2,500, just under, institutions across banking, lending, payments, insurance, investments, retirement funds, and fintechs, again, to understand the opportunities and risks that AI presents to South Africa's financial ecosystem. It reveals a sector that is cautiously optimistic about AI's potential, and as one would expect, some range in the pace of adoption. So in 2024, global investment in AI by financial institutions surged past $50 billion, with forecasts now predicting the spending to exceed some $150 billion annually by 2028. South Africa is part of this wave with some similar and some unique challenges and opportunities. So what we've seen is that fintechs are leading AI adoption in South Africa, with 2/3 already integrating AI into their operations. Banks follow closely, with over 50% adoption. The insurance and lending sectors remain more reserved, with adoption rates below 10%. This disparity reflects not only differences in technological readiness, but also varying levels of regulatory clarity, risk appetite, and strategic focus, some of which has already been spoken to by some of my colleagues. This differentiation in adoption also flows through to investment, with banks, on average, each investing almost 20 times more than the rest of the sector. This signals a strong commitment to not just digital, but AI transformation in the banking sector ahead of other market segments. In South Africa, AI is being applied in ways, again, similar to what we've seen described in other jurisdictions, and so I will not repeat these. It talks similarly to streamlining operations, improving IT systems, helping institutions be more efficient, improving customer service. But in thinking around the chatbots, this is surely a place where behavioral science and positive user experience should be prioritized, I think has been, just to speak to some of the experiences here. So South Africa therefore echoes the international experience, as has been reflected by the OECD. The applications of AI are diverse, but for a conduct regulator, they all link back to one fundamental question: does this serve the customer's best interest? while AI can enhance fraud detection, it is also being used for product promotion and customer engagement. We must ensure that hyper-personalization does not become a byword for hyper-exploitation, and that generative AI chatbots are not mis-selling complex products to consumers who do not understand them. The financial crisis of 2008-2009 taught us that market conduct and consumer protection failures can destabilize financial markets at a global level. We are seeing that AI can accelerate harmful practices on a wide scale, and we must take steps to safeguard consumers to in turn protect the integrity and the stability of the financial system. So with innovation comes responsibility. Reputational risk, data privacy, and ethical concerns such as bias in AI models follow closely. Of concern, about a fifth of South African institutions reported not using any explainability methods for their AI models, which raises serious questions around transparency, accountability, and consumer protection. From a regulatory perspective, data protection laws, for South Africa we have something called the Protection of Personal Information Act, are seen by our financial institutions as the most significant constraint to AI adoption. But let me be clear, these are not barriers to innovation. They are essential guardrails that ensure technology serves the public good. This industry concern, however, highlights the need for coordinated international efforts to balance ethical and operational challenges of AI with the opportunities that are presented. The report for us has underscored the urgent need for robust governance frameworks. These include model validation, risk management, board oversight, and ethical guidelines. AI must be deployed in a manner that is fair, transparent, and accountable. Human oversight is not optional, especially for our reports, and it is imperative. We must ensure that AI systems do not perpetuate discrimination, exploit consumer vulnerabilities, or operate in opaque ways that undermine trust. Financial institutions must be able to explain how their AI systems work, what data they use, and how decisions are made. This is not just a matter of compliance, it is a matter of integrity. To support the safe and responsible adoption of AI, we recommend several key actions. First, to encourage the use of explainability methods, which help demystify complex AI models. Second, institutions need to establish clear governance frameworks that encompass data governance, model risk management, and ethical oversight. Third, we must strengthen collaboration amongst financial and information regulators and possibly others that intersect with our environment, like telcos. The very nature of AI, with its reliance on data and its potential to concentrate market power, means we must also work in close partnership to ensure a holistic and robust regulatory response that balances innovation with accountability. Fourth, consider prioritizing high-impact use cases such as fraud detection, credit scoring, and consumer protection, where AI can deliver the greatest value. Sorry, I really do seem to be struggling with my tech today. Fifth, there is a need to develop national standards for ethical and accountable AI in finance. These standards should be aligned with the international best practices, and we've spoken today around the OECD AI principles, the EU's AI Act, while of course being tailored to the South African specific scenarios. Sixth, invest in digital and AI literacy, not just within our institutions, but across society. Consumers need to understand when they are interacting with AI, how their data is being used, and what rights they have. Financial literacy in the age of AI must include an understanding of algorithmic decision-making and digital risk. But let us not forget the broader implications of AI for financial stability. As AI systems become more interconnected and reliant on third-party providers, the risk of systemic failures increase. We must be vigilant in monitoring these dependencies collectively monitoring these dependencies. This is not just for the stability regulators, it's also for the likes of conduct regulators who are often the first point of contact for many financial institutions. We must be vigilant in monitoring these dependencies and ensuring that our regulatory frameworks are agile enough to respond to emerging threats. In conclusion, AI holds immense promise. I think we well recognize that. But its success will not be measured by efficiency gains or profit margins alone. It will be measured by its impact on people's lives. As the FSCA, our commitment is clear. We will embrace innovation, but not abdicate our responsibility. We will work to build a future where AI serves the people, protecting the vulnerable, rooting out bias, promoting genuine inclusion, and strengthening the integrity of our financial system. So I really hope that through forums like these, we can work together to build a future where technology and trust go hand in hand. And I can really second the read of Nexus. It's a fascinating journey. Thank you very much, everyone.
Thank you very much, Kathy. And now to close on this very rich and wide-ranging conversation, we've asked Vas to offer his reflections on the themes that are emerging from the various speakers, but also to share from his own experience from Ireland. And then we will have a few minutes for questions and comments from the floor. Vas, over to you.
That's great. Thanks very much, and thanks very much to the FSCA and to the OECD for organizing this session. Just to start where Kathy finished off, it's really great to have opportunities to share perspectives and share our reflective experiences on the use of AI in the financial system, and then what this means for regulation and supervision, and ultimately the public policy outcomes that we're trying to achieve. I mean, it's clear, and a number of people have mentioned this, that AI presents very, very significant opportunities for the financial system, but it needs to be done in the right way. I think one of the key words in the OECD's AI principles is trustworthy AI, and this is particularly critical for finance, because ultimately finance is all about trust. So what I'll try and do is bring out some of the themes of the discussion and then blend in a little bit of our own experience in Ireland as part of that. So one of the key issues that was in Carmina's presentation, but a number of people mentioned, is us regulators, authorities, central banks, understanding what the latest use of AI is across the financial sector, across different parts of the value chain of finance. And how do we do this, as Shigeru mentioned, in an agile way, given the speed of development in terms of technology? So this is something that ourselves we're doing at the Central Bank of Ireland. We're also an integrated authority. We have both prudential and the conduct mandate, and we cover all sectors. So we do that in different ways, partly through our day-to-day supervisory engagement with regulated firms, partly through our innovation hub, where we engage with innovators, partly through a forum. We have an industry forum, and one of the focuses of that is on innovation, and a focus of that innovation forum is on AI this year. But also partly through things like surveys, sectoral deep dives. We're doing one at the moment on insurance, for example. But that's one key area, to make sure that we understand where the financial system is and keep up to speed. The second one is about the approach to supervision and regulation. I think in the OECD study in Carmina's presentation, one of the main points was that, well, we have the rule book there. It's technology. It's not kind of by function of a specific technology. So it is there. And the reality is that we have a number of foundations to be able to think about the use of AI in the financial system. So if you break it down into different bits, a key element of it is the inputs to these models. And we have standards around data governance, data quality, data protection. These are there. Then you have the models themselves, and we have standards around model risk management. Then there's the question of the outputs of the model. So there is some more novel issues that we need to grapple with, including questions around interpretability and explainability. And then there are some cross-cutting issues like operational resilience, like cyber resilience, like overall governance, that again we have very strong foundations to build on. The third thing is that I'd flag is about deepening our own understanding of the public policy implications of AI in finance. And one way of thinking about it is that there is a lot, and a number of people mentioned the investment that is happening by the private sector in the use of AI. Of course, there's a lot of investment by the private sector in the use of AI. There is a risk that we need to guard against, that we collectively underinvest on what are the public policy questions in terms of the use of AI. So one thing that we're doing at the Central Bank of Ireland is we are funding a dedicated PhD program, specifically on AI and data science. That has a number of objectives. It helps build a pipeline of AI talent that's equipped to tackle emerging challenges in Ireland. But it's also intended to shape the direction of research in relation to AI from a public policy lens. And our first iteration is on this question of interpretability and explainability that Kathy also mentioned, in the context of what will be more high-stakes public interest settings, and that includes finance. Fourth thing I'd flag is, again, from a kind of public policy lens, how do we shape outcomes? And there are a few people mentioned innovation sandboxes, and we have one in Ireland as well. That is not specific to AI. It's not specific to any technology. But the way we've approached this is, again, with a public policy lens in mind. It's by identifying first what is the public policy question that matters. And our first iteration this year, it was about financial crime. Going back to trust, combating financial crime effectively is critical for maintaining trust in the financial system. And there are a number of initiatives as part of this sandbox. Some of them used AI. But ultimately, it was what is the key public policy question that we have, or public policy interest, and then using the sandbox as a way of making sure that technology and innovation is delivering those public policy outcomes. And last but not least, investment in our own capabilities, including our people, that is critical for all of us. Again, ourselves, we are on a journey, like many of us around here. Part of the use that we have at the moment is in terms of specific aspects of our mandate. So, for example, from a conduct perspective, we've developed a tool that basically scraps the internet and the website for unauthorized providers of financial services, and we use that as a means of identifying proactively potential unauthorized providers. So, again, the possibilities are endless, and this is just one example. But then we also have our own internal capabilities, our own human capital, and then of course the effect of that on productivity for ourselves. Again, the one thing I would say is that you have to do this in measure the impact of it. So we've done some experiments internally about chatting with documents and chatting with data to try and actually measure the impact on what does it mean for the accuracy of outputs, what does it mean for productivity. And there are very positive effects overall, but in some cases there are more mixed results. So I think also learning and evaluating how it is that we use AI internally and what the implications of that is another important dimension. I'll stop there. Thank you.
Thank you so very much, Vas. I think you have now brought us to the point where we have a bit of time to take a question or comments from the floor. And I see there's a few hands, and then we'll do that, and then we will see if we are able to conclude. This side of the room? Yeah, I saw two hands there. Microphone? Oh, you've got mic.
Thank you, and thank you for the rich discussion. I'm Ed Kieswetter. I am the Commissioner for the South African Revenue Service. I'd like to give just a practical perspective and say something probably quite cynical at the beginning, that we've been able to advance our deployment of AI quite significantly and progressively because there is no policy environment and no regulation. And why I say that is that we're on a path that has no precedence, and therefore one must carefully balance the development of policy and practice as an indivisible nexus. If policy gets too far ahead of practice, we may, in fact, suppress the experimentation, the adventurous and exploratory nature of this new technology. Whilst at the same time, one must not have policy and regulation too far behind, because one needs some guardrails, but realizing that we're on a path that none of us really fully understand. So what has it helped us do that we believe has had significant productivity and social impact benefits is we have, for example, this year, we are now, as of today, 9 days into our tax filing season. We've already issued almost 65% of our individuals with a assessment without them having to have to submit a return. We've drawn only on third-party data, and we've used machine learning algorithms and AI to perform the assessment, and as well as a fraud risk detection AI to ensure there's no impermissible or fraudulent refunds. The value of that is that whilst 20 years ago it took us 6 months to conduct an assessment for almost 6 million taxpayers this year, they will not have to file. The other 2 million who choose to file will receive an assessment in under 5 seconds, and will have refunds paid out in under 72 hours to most of them. So as of today, 9 days into filing season, we've already issued 12 billion rand of refunds, which is excellent for both returning money into the economy, whilst at the same time raising additional 3.5 billion of assessments. There is no way we could have done that if we had to not deploy technology and AI. And one of the ways that we've earned the trust from the public is to lead with service, not with enforcement. In other words, we've demonstrated that there is a significant value proposition to taxpayers and the public by our deployment, whilst almost silently and invisibly to those taxpayers, we have been enforcing and preventing. Last year, $5.5 billion US dollars of impermissible refunds we were able to prevent from flowing out because of the deployment of AI. So I guess my point is to understand the nexus, but also not to go ahead with regulation and policy without understanding its practical implications. Thank you.
Thank you. I think it was a really good discussion, and I will just pick up a little bit on Catherine's point. And I am at Central Bank of Sweden. I used to be a regulator as well in my previous life. So thinking of the things that has been problematic for many years in the financial sector is it's to some extent underselling credit to corporates. I fully understand that, but in my view, it's also overselling. Overselling to consumers, and that's credit, and that's products that are mispriced, that is very complex to understand. Another problem with the sector is that many of the products are extremely expensive. We also have the fraud issue, and of course the cyber issue. So all of these, and there are many others, need to be also kind of captured in the discussion here. And there is a risk that all the good things coming with AI, also these negative things could actually increase. And especially worried about the overselling, because typically the incentive for credit institutions is often to sell complex, non-transparent products to people that don't understand. I'm very blunt here, but that's part of the industry that is very much on that side. And of course, they will also use AI to explore those possibilities. So I think even for sure there is a lot of potential, operational potential, and also of course for supervision. I think there is a lot of risks here in this because of the incentives are still the same for many of the industry participants, namely to gain sometimes short-term gains, and I think maybe the technology could increase. So it's interesting to hear if you have any comments on that. Thanks.
Any further comments?
Sorry, thank you very much. My name is Seiichi Shimizu of the Bank of Japan. So thank you very much for very insightful and helpful presentation from all of the panelists. I understand that one of the important facts is that the AI has both the risk and opportunities, and which we need to address both of them. And this is a quite simple statement. But key question is how to make balance between the two. And absolute answer is we need to strike a right balance or the appropriate balance between the two. But in reality, it might be very difficult because, well, my impression based on my regular contact with financial institutions that they are quite cautious in taking action in this area. Probably partly because some of the reputational risk or something like that. And so my question is, well, how to make this balance? And also, well, indeed, as my colleague Elizabeth suggested, the Japanese authorities now emphasize the risk of not taking action in this area. So which means that the Japanese authorities would like to promote the usage of AI in the financial sector. I'm just wondering, so this is simply the matter of the time. So it will take more time for the financial sector to adopt the AI in their business, or it is simply because of their inherent nature of the cautiousness in the financial sector. Or in other words, so to what extent the financial authorities or supervisors will promote or encourage the financial sector to use AI in this environment? So that's my key question. Thank you very much.
Oh, thanks. We can take one more for this round and then go back to the panelists.
Thanks very much, and great presentations. I'm Sarah Breeden from the Bank of England. Mine, two questions, which is a bit cheeky, I know, stem from the fact that this is a profound change. I think everybody said that. And yet we're approaching it in a principles, pragmatic, nimble way, building on our existing regulatory frameworks, even though there are these challenges of explainability, interpretability, dynamism, accountability. So my question is, what would we need to see to change our approach from being tech agnostic to being somewhat more directional? And then my second question is, AI gives us all an opportunity to radically reimagine how we do our jobs. Are there any priors about where we should focus that desire to radically reimagine? What are the most likely use cases? When I was in San Francisco talking to some of the AI firms there, they said, in football, the referee is on the pitch. And I thought that was really telling about thinking about how we as central banks can just fundamentally, and regulators fundamentally rethink how we go about doing our jobs. Do panelists have views on where we should best focus?
Can I just ask a question, and maybe the panelists, because it's very much on building also on what Sarah just said. To me, a lot of it depends on where do we keep the human. And if you could say a little bit like in that loop, right? The hard things should be done by AI, but how do you make sure, and how do we understand where the human should be to make it really safe? So if you have any examples of that, or tell us a little bit how to think about that, it'd be great.
All right, very difficult questions. Who wants to go first? Paolo?
Perhaps a story that addresses some of the questions, and especially regarding the balance between the innovation challenge of risk and opportunity. And also Andrea's question about where the human comes in. And again, stressing the importance of a sandbox. Just a quick and interesting story. A financial institution started using AI to try to have a personal assistant of investments for people. And at the end, they found out that the recommendations were not maximizing the return of the investor, but they were maximizing the commission of the recommendations. And this seems no surprising because the corpus of information which those models are trained are human-based, so they were practically replicating what my personal assistant usually does. So I would say that on an evolutionary perspective, I mean, there will be mistakes along the way until we reach a very adaptive and efficient final solution. And in the meantime, we have to keep humans in the sandboxes, analyzing the results of the models, and then again interfering. And at the end, I believe, like other authors, that we're looking much more in terms of superintelligence than artificial intelligence, which is human intelligence augmented by the power of this technology.
Well, the first question, where's the left? Sorry, because of course this was a very, very important question. And one that the question about do we risk to regulate too much or too fast or too early? And that's a question that is, of course, with every kind of new technology, we always face these kind of trade-offs. We always face this kind of difficulty. Some observers in Europe, surely some observers fear over-regulation. Some stakeholders are worried that the AI Act may impact their ability to innovate. I think, well, in our case, I think that it's important, as I said, to apply the new framework flexibly. I think that there's still a few, in the European context at least, there are still a few issues that have to be streamlined, including the coordination among the various authorities that are involved in the application of the Act. And of course, there is an issue of flexibility in applying it, and the general issue of simplification, which goes beyond the field of artificial intelligence. And I think this is something that is rightly taken seriously by European authorities in these days, because there may be times when the trade-off is not entirely right. Having said that, I'm instinctively an optimist, but still I have to admit that what the issues that Eric today raised are real issues. The consumer protection is an issue. The only thing that I would reply to his points is that, there is a famous children's tale in Italy that is called Pinocchio, and I think that is thanks to Walt Disney, it's known beyond my country's boundaries. And some may remember the two characters in Pinocchio, the fox and the cat. Then a fox and a cat robbed Pinocchio in those times the means of payment were gold sequins. They rob Pinocchio of the gold sequins by promising that he will get much more because they can sow it and then grow a plant that will multiply his sequins by tenfold or whatever. That, I mean, the cat and the fox have always existed with financial technology or no financial technology, old technology or young technology. And I think that some of the issues that we are facing with the new financial systems are very similar to the cat and the fox's and ideas. So this means that the problems are basically the same. The means, the technology, the methodology to face them may be different, but the principles are not that different. And then, of course, there is a trade-off. You would like to have something that is neither too fast nor too slow, neither too strict nor too lax, but to reach this kind of Goldilocks optimum is not necessarily easy. We need to experiment, especially with things that are new, and so we are necessarily ignorant about them. And that's partly the answer to one of Sarah's questions, which is a very important answer, a very important question, which is where do the human intelligence come in? And what are the possible applications that are probably more promising? I can tell about one thing that we are working on, which is, I mean, one of the tasks that the insurance supervisor in Italy takes much time of insurance supervisor is the management of complaints against insurance companies. When I say much time, I say that because there are tens of thousands of complaints that we, as the authority, receive, and we take this very seriously and want to go as much as possible in depth and involve the companies or intermediaries that are involved and find if possible, a fair and just solution. Now, managing 35,000 complaints a year, I think, is potentially an ideal task for artificial intelligence. Not the artificial intelligence can do all the job. In the end, there must be a human. But how much do we need to, at what point and how much do we need to involve human? I think it will be a question of experience. And I think we should be humble and modest enough to say that we don't quite know for the moment. We are experimenting in a project like on this. And I think we'll gain experience. Of course, we'll be happy to share experience with others if the others are interested. But well, at some point, you, Carmine, seemed a bit disappointed that the artificial intelligence is helping human intelligence but not entirely replacing it. Maybe on one day your disappointment will not be justified, but I don't think that I'll see it. I think it's something for the next generation. For the time being, I think that human intelligence, human judgment, human assessment must be firmly into the loop. But the precise, since Sarah asked the difficult question of the precise time, the precise boundaries of this involvement, this is not something that I think I can answer 100% at this moment, and experience will tell. Thank you.
Thank you very much. So, because we're towards the end, I'm just going to budget time, trying to be efficient. 1 minute for Kamine and the rest, and then we will conclude.
I cannot resist to mention another Italian, Carlo Ponzi, Charles Ponzi, and I think the story is always the same, unfortunately. And again, so on the one side, but
only honest Italians.
Yes. No, unfortunately, our colleague left, but okay, this is, I think, a good example. But then I think that Eric was also a supervisor, a regulator some time ago. I think shows the urgency also of so having an intervening and using for because this is AI may be used for let's say intended consequence of let's say having more commission. Now, striking the right balance, where are the humans? I think humans are the customers on the one side, and the literacy understanding, but also the practitioners, financial market, and supervisors. So investing also, I think, humans in upskilling, in better preparation, also in the financial market, but also in the supervisory side, and striking the right balance, use a sandbox and others. So maybe means also to have a good buy-in of financial market participants without stifling innovation. By the way, AI supervision, Sage is here, is the new chair of our financial market committee. AI supervision, AI open finance will be the topic of the discussion, CMF in September. Thank you.
Thanks. I don't think I'll need the minute because I think the honest answer is I don't know. I think that's the honest answer. But I think the way I would approach it in terms of kind of when we would need to think about it very, very differently is like at what point, well, I would start with what are the core functions of finance and at what point might AI be getting kind of very close to those? So capital allocation. If it start getting into questions like capital allocation, decisions around that, this is macro relevant, this is macro critical, and I think that goes to the question of where does the human need to be, and there you need judgment, kind of the AI can inform, but you need judgment, because the reality is that we know from history that all these models, all models, are based on the past. And finance, the other thing we know is that it's dynamic, it changes all the time. So this can't be a blind reliance on models for big macro-relevant decisions. Yeah, thanks.
So I think that's a very good segue for what I wanted to come in, which is to highlight the importance of being very clear about the policy and the regulatory outcomes that we're wanting to achieve. And this actually filters through to how we supervise the institutions as well in terms of what are the expected outcomes that we have for financial institutions, and whether that's from a safety and soundness perspective, whether it's from a conduct perspective. So for us, and it's touched on a number of issues here, it's not just about the rules and requirements, it's about are we seeing the right impact on, for us, consumers. So are consumers getting the right product at the right time to be used in the right way, and are they actually using it in the right way? Now, those are things we can be exploring and testing with financial institutions, including how AI is feeding into that decision-making. Thanks.
Thank you. I'd like a couple of points. One, I don't have a clear-cut answer to what Sarah mentioned, but one thing is clear is that do we have the right people? Do we have people who understand tech, and do we have who people understand what our mandates are at the same time? And this is a fierce competition with the private market. So that's number one. Number two, what I would be concerned about is about, not about the micro level, but the macro level. For example, I'm not an economist, but fallacy of composition, for example, herding behaviors, financial exclusion. Here, for specific companies, it's not a problem if they decide on providing finance, providing insurance, but as a whole, it could become a huge problem, and we don't have any clear-cut answer on how to answer this question. And I think it's the same about herding behavior. And this might be somewhat of a hint on how we involve a human in the loop, in a sense. Where do we involve a human in the loop? Last but not least, to Eric's question, I think Seiichi mentioned about maybe Japanese banks being too cautious. That's why it could be a jurisdictional sort of manifestation, but there are differences between jurisdictions on what will be important. Thank you. Thank you very much.
Thank you very much. Thank you very much, everyone, for a very dynamic and helpful conversation, I think. I'm not going to try and summarize, but just 5 key takeaways in terms of things that I felt were emerging or thematic issues from the conversation. I think the first one is a clear public policy lens that we should be applying. So issues of safety, trust, ethics, transparency, accountability. I think all of us are clear that the technology has to be able to deliver on these public policy imperatives. And we need to be investing in our own capability to monitor that technology, the technology as it changes, is continuing to deliver on these, and we are able to assess, as the people with the responsibility to regulate and to supervise, that the technology actually is doing these things. And when it's not, obviously for us to be able to take action. And in terms of regulatory frameworks themselves, if they're principles-based and flexible, I think there was a lot of emphasis on being agile. There is no need that right now, there's no pressure right now for an overhaul from a regulatory framework perspective. But I guess the more we monitor and keep close the more we'll understand if there are gaps at all in terms of our regulatory frameworks, and then we'll make those changes. And I think the last one, which is quite obvious, international cooperation, which is key for mutual learning. There are multiple issues relevant globally, relevant at different pace and scale in different countries. With that, thank you very much to the participants and to everyone who's contributed to the conversation. Thank you. Thank you.